Well, I'm Yang Rui with the Dialogue, brought to you from Beijing. Part of the current government-led campaign to deepen the reform is to restructure the banking system in China. And liberalization of the interest rate tops the agenda of the new leadership. Premier Wen Jiabao attended a consultation meeting last month at the People's Bank of China to solicit opinions about financial reform. He called for market-based reform of the interest rate and said he wants to help small and medium-sized enterprises to enjoy easy access to loans. Here with me in the Beijing studio are Mr. Yukang Huang, Senior Associate with the Carnegie Endowment for International Peace, and Mr. Xiang Songzuo, Chief Economist of the Agricultural Bank of China Limited. Before the discussion, let's look at this.
Since the liberalization of the interbank rate in 1996, China's central bank, the People's Bank of China, has been making efforts to promote market-oriented reform of interest rates. In 2004, the bank removed its lower limit on bank deposit rates and permitted lending rates among lenders to be 10% lower than the benchmark rates. In June 2012, it allowed banks' deposit rates to be 10% higher than the benchmark, while cutting the lower limit of lending rates to 80% of it. In July, it further reduced the limit on lending rates to 70%. During Premier Wen Jiabao's visit to the central bank on January 21st, he stressed that China will steadily push forward market-based reforms on interest rates.
Welcome to Dialogue, gentlemen.
Hello.
How harmful is the low interest rate?
Low interest rate, we can talk about harmful for low interest. We can just talk about the harmful, even damage of regulated interest rate. Interest rate is the most fundamental importance for all economic system. I think it's the most important price for all economic operation, which is a driving force, is a fundamental driving force for allocation of scarcity resources. So in order to make the perfect or even efficient allocation of resources, we need market-oriented determined interest rates. So that's why at the beginning, since the middle 1990s, the Chinese government began the launching the liberalization process of interest rates. And so far, we had made great progress in this regard.
Now, Yukang, what were the major measures that have been taken by the Chinese government since the mid-1990s to liberalize our interest rate?
Well, they've tried to adjust the rates with the changing circumstances, primarily whether inflation is higher or lower. It's also affected by whether or not there's a lot of capital inflows into the country, because if interest rates are quite high, it attracts more money, and China's been worried about too much capital inflows. So capital movements, inflation, whether the economy is expanding or contracting, these are the major factors that affect the adjustment of the interest rates. I think the really difficult issue in China is if you want the market to determine interest rates, which is a long-term objective, you don't have actually a very strong capital market in China. So it's actually very difficult to say how can the market really change or affect the nature of interest rates. So it has to be actually managed by the government officials, and I think this is very difficult.
Now, Professor Xiang, what does Yukang mean by having a poor capital market in China, which does not necessarily help very much?
Yes, I think if you want to have a very efficient allocation of resources, and you want to have a perfect or efficient liberalization of interest, you must have a very deep developed monetary markets, equity markets, bond markets. So now the PBC and other regulators have taken measures to proceed in this direction. First of all, we liberalized in the middle 1990s. We liberalized interest rates gradually, of course, interest rate for bond markets, for interbank offering markets, for commercial paper markets. But in this century, particularly in the previous few years, the PBC took measures to liberalize gradually the deposit interest rate and the lending interest rates. So, for example, last year, PBC took great measures to expand, enlarge the adjustable band of interest rate for lending as well as for deposits. So there is a very high adjustable bond, and for small bankers, for cooperative financial institutions, they can adjust their interest rate to depositors as well as to borrowers at most could be 20%. That's with a very large space for the financial institution to adjust. Of course, the bond markets also we observe the very fast, very quick development of bond markets. The bond market, I think, is essential to liberalize the interest rate because the bond markets can, provide the so-called benchmark interest rate for every kind of financial products. So that's why the senior officials of PBC emphasized at the beginning of this year, we need a so-called yield curve. The yield curve must come from the bond markets. So I think in the near future, they will take more measures to, speed up the development of a well-functioning bond market, not only national bond market, also local and the corporate bond markets.
I appreciate your articulation about those key talking points. However, despite the clarity of the roadmap concerning financial reform, why have most of the small and medium-sized enterprises failed to benefit from the flawed, well, of course it's a flawed financial system? For example, these small and medium-sized enterprises have contributed up to 50% of the income tax, 60% of the GDP, and 80% of the employment market. And yet, 90% of the loans went to state-owned enterprises instead of those unfortunate players of the non-public sector. What do you think of the mishap of the SMEs here?
All right, I think you have a very difficult situation. If you go to the commercial banks, where they are state commercial banks or private commercial banks, your first objective is to say to them, you should be very careful in your lending because you need to generate profits. So they have to be risk averse. Their first instinct is to lend to the bigger corporations because they seem to be safer. Their instinct is also to lend to the state enterprises because they believe the state enterprises are backed by the state. So their lowest priority is the small, medium, private enterprises who are risky, and there's no likely any government guarantee, so banks are inherently reluctant to lend to SMEs. Now that's true not just in China, although the problem I think is more serious here. It's even true in the United States. So in the United States you have to have specialized agencies and specialized credit lines to deal with small and medium enterprises because you recognize that there's a very high risk. And the real issue is how much risk should interest rates bear? How much exposure should banks have to these SMEs? And I think what's missing in China is that most SME lending in the West is also backed by what I call venture capital funds, equity funds, special programs which do not lend on the basis of interest rates, but lend on the basis of partnerships and stock, which is then paired with lending from the banks. I think this is what's needed in China.
What do you think of the sense of urgency on the side of the state-owned banking system to diversify their loans and diversify the means of financing? For example, is it only about loans, or, for example, private equity, bonds, and other informal?
I think that's already established national policy to diversify the so-called social financing structure, to improve the social financing structure, which means
informal banking has grown explosively.
So we must increase the share of direct financing among the total social financing, which means develop more PE, VC, and other financial products by small financial institutions. Of course, we need more equity financing, bonds financing, such as corporate financing, and even insurance and trust products. So that means the share of big state-owned bankers lending among the total social financing will be decreased significantly. Yes, in the past few years, the share of these big bankers lending among social financing has reduced very significantly, and I think that will be to some extent beneficial to SMEs. However, for financing problem issues of SMEs, we need rational as well as practical judgments. I think the financing problem of SMEs is a worldwide problem, not only in China but also in the US, Europe, Japan, and other countries. Why? we need practical judgments. 1/3 of SMEs has not, conditions, and they cannot meet conditions for any financing loans.
Given the risks, how can the SME be trusted?
Well, let me just give you a statistic. About 60% of the new SME enterprises or small businesses in the United States fail in a year or two.
Yeah.
So you have to realize that if that's the case of risk and failure, even in the United States, with well-developed capital markets, it's going to be just as risky in China. So that means that when you start a small business in the U.S., you have to have people who are very familiar with what you're doing. You have to put up a fair amount of your own money or get private people to back you up. And only when you have that kind of both understanding accounts and some money of your own from whoever, wherever, will the bank then support you. And they'll support you, but they also will charge you a very high interest rate because they realize the risk of failure is very
led to the bankruptcy of many
in
small
China, the average life
enterprises
expectancy of SMEs in China is 3 years, less than 3 years. And many of them, SMEs, has not collateral. And many of them has not clear-cut the balance sheets or financial reports with, in accordance with the GAAP, general GAAP accounting principle. So the bankers must take all these issues into account of their decision to grant lending to SMEs. So 1/3 of the SMEs has already got bank lending in China, and another 1/3, cannot never get bank lending because of the lack of any financial report and collateral. And the final 1/3, they don't need any bank lending. For example, the small restaurants, the many individual small business, they have on there enough own capital to circulate, so they don't need bank lending. So, talking about SMEs financial issues, we need practical judgment. We don't blame anyone for lack or insufficient financing for SMEs. For SMEs have their own problems, which must be solved by themselves as well as by support of government.
But I think in China you have the special problem of the state enterprises commanding such a large share of the lending. And because they command such a large share, by default, of course, the money available for the private sector or for SMEs is less than probably it is in the West. And the real question is, how do you basically try to shift that, make it more balanced? And I think in this way, the big issue is you have to break this link between state banks, state enterprises, and basically try to have what most people call a level playing field, that they become more open to lending to everyone. And the big problem is, if you lend to state enterprises, you always think the government's going to back them. So even if they collapse, even if they're bad businesses, you as a bank think you're going to be protected.
Even in America, people would say, hey, some of the banks were too big to fail. They need the backing of the government, federal government, so to speak.
The U.S. has a too big to fail problem, and they've only gotten bigger because in the financial crisis, some of these smaller banks actually were merged with the bigger banks. So too big to fail became even a worse issue in the United States. I would say personally that China has its own version of too big, and I would call it too big to manage. These big four banks, with all due respect to my colleague here, you have very large banks who, because of their size, have a very dominant position. And because China is so big, it's very difficult to ask the question, can they become more specialized, responsive to local interests? In some ways, they are responsive to local interests, but these tend to be local state interests rather than local private interests. So I think there's a big issue in China in terms of whether or not these big banks are actually too big to manage.
Well, Professor Michael Khadrs and Zhu Min, a senior official of the IMF, both pointed out that the country's artificially low interest rates have hurt depositors very seriously and made capital very cheap, lending to the formation of real estate bubbles. What did they mean?
Yes, I think in the past 1 decade, many years of past 1 decade, the real interest in China has been negative, which according to historical records,
that amounts to exploitation of the individual consumers.
Yes. So that's equivalent to exploitation of small depositors when the people deposit their money into banking, but they got a nominal interest below than the CPI, the inflation indicator, which means they got a negative return from their deposit, which of course is not unjust for the small depositors, even particularly even for the low-income people. So that's why the basic principle for monetary policy is to guarantee the positive return for depositors. I think that's one driving force for liberalization of interest rates, which means the depositors can diversify. Of course, first of all, their investment. Not only they can deposit their money into bankers, but they can invest money in other products.
For example, can they put their money in the stock market or real estate market?
Yes.
In those cases, I'm afraid the risks are even higher.
And also they're limited, of course, because it's not easy to move your market outside of China. But if you go back to the interest rate issue, it's a common assumption that Chinese savers have been penalized by negative real interest rates. But in fact, it's not actually true. If you actually look at it, for example...
Excuse me, are you saying it's not true?
No, it's not true. If you look at today, if you put your money in Chinese banks, which I do, 1 year savings account, I get 3%. In the United States, I get 1/4%.
But what about the inflation rate in China?
Inflation rate in China is, let's say, running at 3% or 2%, somewhere around that. In the United States, it's running around 2.5%. But they pay me only 1/4%. Now, 75% of the interest rates globally are all negative. So there's a kind of interesting question. First of all,
you have to make sure which is the lesser evil.
Well, but different years. Last year, 2012, the real interest in China is positive. But I think from 2004 to 2008, many years now it's negative.
Right. So. But there's a study done by the Peterson Institute of International Finance over the last 10, 15 years. What it showed actually was 50% of the interest rates globally were negative. And actually 1/3 of the interest rates of the major economies over the decade were negative. Now, the real tricky question is, interest rates can be negative or positive, but in the West, they're set by the market. And here, they're set by PBOC or the Monetary Committee. So, in some sense, what the Western economies are saying, you should really be able to have flexible interest rates. These interest rates could be negative. They could be positive, but they'd be set by the market. Now, interest rates now are actually negative, pretty negative in most countries in the world because of quantitative easing and all this money out there. Now, if you think about it, if you actually had a true market interest rate in China, truly set by the market, demand, supply, it's unclear whether interest rates would actually be negative or positive because you have an enormous amount of savings in this economy, more so than normal.
But of course,
thank you very much. We have to leave you there for the moment. You are watching Dialogue with Professor Xiang Zongzuo and Mr. Yukang Huang. We are discussing reform of China's financial system, particularly the banking system. We'll be back in a few minutes. Welcome back. So what does the government mean by liberalization of, say, hopefully market-based interest rate?
The ultimate objective of liberalization of interest rate is to net the supplier and demander to determine any interest rate. Of course, interest rate, there is a structure, the short-term and the long-term interest rate. Long-term, the bond interest rate, for example, 10 years, 20 years, and the 3 years, the bond interest rate is a very long-term interest rate. And there is a short-term interest for 1 day or 1 week or 1 month. So I think for China, we, like any reform in China, we took gradual approach to liberalize interest rates. So I think now the lending interest rates to very much extent has already liberalized. So in the future,
for example, let's look at asset management. Do you think we're going to expect a higher yield of such asset management?
I think the problem here, not the problem, growth in China is, let's say, 7 or 8%. It's much higher than the United States, which might be growing at 2.5%. So you expect higher interest rates because productivity is higher here. There's greater demand. But you go, for example, look at the mortgage market. The lending rates for mortgages in the U.S. now are around 2 to 3%. Here, I think they're much higher. The tricky question here is when you liberalize the market here, and you say, we'll let the market determine it, you also have to liberalize capital flows. You let people invest overseas, you let money come in here. And the interesting factor is if you actually liberalize interest rates today in China, interest rates in China would fall. Because globally, all the interest rates are very, very low. So you have an unusual market. I'm actually starting to move most of my savings to China because your interest rates are paying me 3%. Very safe in the bank here in China. I'm only getting 1/4 of 1% in the United States. I get less in Singapore, less in Hong Kong, less in Japan, less in Europe.
So there are several implications for policy liberalization interest rate, not only just make interest rate more flexible. So we need much more diversified financial institutions, not only bankers, but non-depository financial institutions and many other financial institutions to issue their own products or financial innovations. And of course, there are much more diversified financial products, including asset management, wealth management, and trust insurance products. And the third, much more easier or flexible capital flows, both ways, from outside into domestic market, from domestic market to overseas. So yes, the liberalization of interest rate must have far-reaching implications for all, segments of Chinese financial markets, not only flexibility of interest rates.
Professor Michael Khadrs of Peking University, Tsinghua University, says the raising benchmark rates while incorporating the informal financial sector into the formal one will be an important step, both in reallocating capital more efficiently and in raising the household share of wealth. But by effectively causing the wealth to shift from state-owned enterprises and local governments to less powerful households and small and medium-sized enterprises, it is likely to be very unpopular. And therefore, overcoming these challenges will be an important task for authorities in Beijing, isn't it?
Yes, of course, there is challenge to regulators as well as to state-owned big bankers like ICBC, ABC. So pricing power for all these big bankers will be reduced very quickly, and they must, innovate their products to attract clients and to fight for market share. I think which is a very positive development for enterprises, particularly for SMEs, because they can get much favorable conditions for loans, and of course also very beneficial for depositors. They who can get much more favorable conditions for their deposit products.
Let's look at the relationship between liberalization of the interest rates and how to stimulate the domestic consumption. What's your take?
Well, some people argue that the interest rates affects domestic consumption because low interest rates might encourage households to save more, and therefore by setting it very, very low, they save more and they don't consume as much. Some others actually argue the opposite. If interest rates are very, very low, you don't actually save very much. You consume more because you can't earn much on your passbook. So this is actually a controversial.
I'm a fan of the second opinion. If the interest rate remains low, I got to spend money on real estate. I got to buy more luxury goods, for example, if I can afford.
Interest rate is just one of determinants of consumption, domestic consumption. I think much more important factors determine consumption. Of course, is income, and another is a financial intermediation for individual income, the so-called intertemporal balancing of people's income, future income, and current consumption. So I think in order to stimulate domestic consumption, we need to develop much more individual financial products in order people to have their own intertemporal balancing of consumption, investment, and saving. of course, no interest rates will be beneficial for them to borrow more money for education, for consumption, for everything. But interest rates are just one factor of determines for consumption.
I think I certainly agree with him on this. What's missing in China is a wider range of investment instruments, and these will carry different returns. And the interest rate is only one return for savings accounts, but the returns to equities, to bonds, to other kinds of diversified, even wealth management products, it'll be different, and it'll be priced differently. I think it's what China basically needs.
What do you think of the necessity of putting more money on social infrastructure so that the burdens will be reduced for low-income families and they can enhance their purchasing powers?
Yes, of course. Yes. So I think that's the aim of, or that's the mission of a fiscal policy. So now China government has a so huge fiscal revenue, so they must invest the huge physical revenue much more and more into education, healthcare, infrastructure. So
instead of buying assets in the U.S. or dollar-denominated assets there, because we are the top creditor, and many people question the wisdom
yes,
of
the two things
purchasing American assets.
A bit different, but yes, we must focus more on domestic infrastructure, particularly for education, healthcare. Now the major burden for ordinary people for their expenditure is education and healthcare. Of course, the apartment, the housing. So, how to improve these conditions for their?
The PBC will, of course, calculate which would enjoy higher yield, continuing to buy more of the American assets or spending more on social infrastructure to improve social security programs so that those aged and elderly people in rural areas, for example, can enjoy more social benefits, and they in return, they would help stimulate the domestic spending, right?
No, I think it's a very logical proposition. You could either use bonds that the government would actually buy, and since they have a government guarantee, you get a low interest rate. Therefore, you can actually finance social infrastructure on slightly better terms than commercial terms. That would be desirable. You can even have tax policies which are basically getting revenues from the public and use that for social infrastructure. All this would actually help stimulate consumption and investment, and it would actually reduce some of the pressures on the renminbi.
Right. So how much can individuals benefit from the liberalization of interest rates in the foreseeable future? I'm a consumer. I care more about what can I gain in return as a result of liberalizing interest rates. I'm not a business employer. I'm not running a big company.
If you look at development last year, because of liberalization of interest rates, the overall interest rate level for Chinese economy has been reduced quite significantly. So that means, for example, Mr. Yang Rui, you can pay a little bit less for your credit card, and you can pay a little bit less for your mortgage and for everything. So I think that's very much beneficial to individuals.
Thank you very much, gentlemen, for being with us. With that, we come to the end of this really interesting discussion about liberalization of China's interest rates as an important part of the next step to deepen China's reform. I'm Yang Rui, and see you next time. Goodbye.
Importance for all economic system. I think it's the most important price for all economic operation, which is a driving force, is a fundamental driving force for allocation of scarcity resources. So in order to make the perfect or even efficient allocation of resources, we need market-oriented, determined interest rates. So that's why, at the beginning, since the middle 1990s, the Chinese government began the launching the liberalization process of interest rates. And so far, we had made great progress.
Allowed banks' deposit rates to be 10% higher than the benchmark, while cutting the lower limit of lending rates to 80% of it. In July, it further reduced the limit on lending rates to 70%. During Premier Wen Jiabao's visit to the central bank on January 21st, he stressed that China will steadily push forward market-based reforms on interest rates.
Welcome to Dialogue, gentlemen.
Hello.
How harmful is the low interest rate?
Low interest, we can talk about the harmful of low interest. We can just talk about the harmful, even damage of regulated interest rate. Interest rate is the most fundamental.
Enjoy easy access to loans. Here with me in the Beijing studio are Mr. Yukang Huang, Senior Associate with the Carnegie Endowment for International Peace, and Mr. Xiang Songzuo, Chief Economist of the Agricultural Bank of China Limited. Before the discussion, let's look at this.
Since the liberalization of the interbank rate in 1996, China's central bank, the People's Bank of China, has been making efforts to promote market-oriented reform of interest rates. In 2004, the bank removed its lower limit on bank deposit rates and permitted lending rates among lenders to be 10% lower than the benchmark rates. In June 2012, it allowed
progress in this regard.
Now, Yukang, what were the major measures that have been taken by the Chinese government since the mid-1990s to liberalize our interest rate?
Well, they've tried to adjust the rates with the changing circumstances, primarily whether inflation is higher or lower. It's also affected by whether or not there's a lot of capital inflows into the country, because if interest rates are quite high, it attracts more money, and China's been worried about too much capital inflows. So capital movements, inflation, whether the economy is expanding or contracting, these are the major factors that affect the adjustment of the interest rates. I think the really difficult issue in China
I'm Yang Rui with the Dialogue, brought to you from Beijing. Part of the current government-led campaign to deepen the reform is to restructure the banking system in China. And liberalization of the interest rate tops the agenda of the new leadership. Premier Wen Jiabao attended a consultation meeting last month at the People's Bank of China to solicit opinions about financial reform. He called for market-based reform of the interest rate and said he wants to help small and medium-sized enterprises to